All right. Well, welcome everybody to our August/September cusp roundtable. We're looking at real estate markets in Toronto and Vancouver every month, as we do with Steve Saretsky in Vancouver. Hi, Steve.
How you doing? Thanks for having me on again.
Always, we need you here. And John Pasalis of Realosophy Realty out in Toronto.
Hello again.
I say out in Toronto, but I'm in Toronto as well. I'm always doing that. Now, Steve, you threatened to broadcast from your honeymoon last month, but I want to reassure viewers that we told Steve he shouldn't do that. That he's
it didn't go over very well. So we jammed this in, I guess we're recording this on the 31st of August. So John and I were kind of chatting. So like, okay, we should have some preliminary numbers based on what the August stats are going to look like. So I'm sure we'll get into that in this week's show.
Yeah.
Great. Well, let's start on that note, Steve. What are you seeing both in terms of the numbers and what you're seeing on the ground in Vancouver right now in the real estate market?
Yeah, it's a little bit better for sure. I think like we went through the initial illiquidity stage where I think it was like a policy shock, right? I remember like the foreign buyers tax when that came in 2016, the market basically froze. Like there was almost no activity for 3 months until people were able to sort of digest it. And I think like that's sort of what we saw was like mortgage rates doubling in the span of 3 or 4 months. I think we had that shock where the market basically seized up and people wanted to see what was going to happen. And so there was basically, we've talked about it in the show, right? Several months of 20+ year low in home sales, probably not sustainable. So we are seeing a little bit of an uptick in sales. Now, I will say that sales still look really weak. We should see greater Vancouver home sales for the month of August. You're probably going to be looking at a 35 to 40% year-over-year decline. And from a historical context, it will certainly be one of the softest years. The only thing that looks like it's going to dwarf it will be, August of 2012 and August of 2008, which again were, historically very soft years in the housing market. So I think the only thing that's sort of countering the very weak sales still, while they have picked up a little bit, we're seeing more transactions. We're seeing transactions happening at lower prices, which I think is encouraging enough people back into the market. That new listings remain incredibly weak. It's actually going to be a 21-year low for new listings in Greater Vancouver. So we are actually seeing sellers playing a bit of game of like tug of war almost with the buyers and say, you know what, like the market's still soft. There's still not a whole ton of demand and I'm not getting my price or I'm getting low ball offers. Let's pull this thing. And so it's really going to come down to, we'll see how things shape up here over the next, 6 to 12 months. But I think the question mark is where do rates go? Do they stay here? And how many sellers have the ability to sort of weather the storm? How many are over levered? Is going to sort of maybe dictate, I think, inventory moving forward.
And John, what are you seeing in Toronto?
I mean, interestingly enough, very similar trends to what Steve's talking about in Vancouver. Definitely, sales have picked up a little bit in August. I mean, we're still at probably 20-year lows. But the market was still, busier in August than it was in July, which is not typical. More viewings, more showings, places selling a little bit faster. Obviously, still a tight market and similar listings have been low. A lot of sellers have been taking their homes off the market, planning on potentially relisting in September, expecting more demand. And we're seeing some stability in prices, like low-rise prices are kind of plateaued pretty much the past couple of months. And I think that's partly because just like not a ton of inventory, like it's just months of inventory, if we look at, is actually kind of have been trending down the past 4 weeks. So like, I think about a month ago, we're about 3 months of inventory for low-rise homes. We're about 2.5 now. And this is the opposite direction that you would expect when the market's cooling. I mean, it's still obviously a soft market. But again, the inventory declining is a combination of like, sales picking up a little bit for August and then, listings being tight. So I think it'll be interesting, as Steve said, to see sort of what the fall market's like. And my instinct is it's probably going to be a little bit busier than what we've seen in the past few months.
All right. Well, now it's time for our regular feature, Interest Rate Corner. So the Bank of Canada will meet September 7th. And we are now hearing from experts a wide consensus that a 0.75% percentage point increase or 75 basis point increase is expected, which would bring the bank rate from 2.5 now to 3.25. So in our chat last month, there was some sense from both of you that the increase could be about 50 basis points. So given what we've heard now, I'm wondering what your thoughts are. Do you still think a 50-point raise is likely, or 75, or what are your thoughts, Steve?
I think I'm going to go with 75. I go 75. I still think it's from 75. I think it's a pause and hold from there. Similar, I guess. I think CIBC, I guess, was trying to make that call, but I think that's kind of where I'm erring. I think the market's pricing in 100 basis points by the end of the year. So, if they go 75, it's pretty much where the markets are wanting them to be. But yeah, I think like one more jumbo rate hike here in September. And I just think like it takes time to sort of filter through into the data. And I think like, looking at Q2 GDP numbers actually were out today in Canada. So actually a pretty large miss. I think the BOC was projecting second quarter GDP at 4.1 and it came in at 3.3. So residential investment down 28%. So I think it's starting to filter through. And like John, and I have talked about here at the beginning of the show is housing activity, while maybe it's picking up or moderating ever so slightly, it remains incredibly soft on a historical basis. So I still think there's more weakness to come that will probably prompt the VOC to hit pause after this.
And John?
Yeah, I mean, I tend to agree with Steve, but probably, yeah, I think 50 basis points isn't happening. I mean, anywhere from 75 to 100. I mean, what happens from here?
100, here we go.
Maybe, maybe they're going to be bold and just kind of do it all in one shot again. I mean, and we'll see what happens from there. But again, I think this is, I think it'll be interesting kind of over time. I mean, I think a lot of stuff that I hear people thinking that, buyers are going to hit pause if they go with 75 points or 100 in September. It doesn't work like that. Like most people who are looking at buying now are expecting a certain interest rate, or maybe they're planning on a 5-year fixed at 5 or 5.5, whatever that is. So I don't think this rate hike will have a huge immediate impact on the market. I think it takes some time for that to trickle through. We're already at 20-year lows, and it might impact, seller volumes in the future if, people who are highly leveraged can't hold on to stuff. So it'll be interesting. So we'll see where we go.
So I'm actually curious your thoughts there on that, just on the, so I just remember when the BOC raised 100 basis points in what was that, June, I think, June or July, we saw a lot of deals that were maybe already had accepted offers with subject to financing actually collapsing because all of a sudden, like, hey, I was qualifying, based on me getting, let's say, a variable rate mortgage, and this is going to change the whole picture. And so, I don't know, my sort of inclination is like, I still think like the majority of Canadians and people that are shopping for homes, I still personally feel like they're not that in tune with like Tiff Macklem at the Bank of Canada of like, you know what I mean? So I think like if they come out with 75 basis points, I still think that's going to bring quite a few deals to their knees. I
mean,
curious your thoughts.
I mean, I don't know if it's going to change demand entirely in the short term. Like, again, I think, so sure. I mean, it's going to impact, obviously, people who look at variable rates, but that's just going to push variable rates closer to fixed rates, right? I don't think, if they go 100 basis point, I don't think fixed rates are going from 5 to 6% tomorrow, right? So, anyone who's looking with a fixed rate mortgage at 5-ish% range, they're still going to be buying a home in September, right? So
yeah, your fixed rates have basically been like range bound for the last 2.5, 3 months.
Yeah, and that's kind of what I mean. And I think what you might just get is just fewer people going variable, right? Because the incentive isn't going to be there tomorrow. Like a lot of the drive to go variables, the spread was so huge. And if that tightens, which is probably what's going to happen, you just get fewer people going variable. You get more people going fixed. And of course, like when I say it's not going to have a huge impact, the impact is what it is now. We're at 20-year lows, right? So when I say it's not going to have a huge impact, I mean, we're not going to go to 30 and 40-year lows. Like it's not going to be that much worse. We're probably going to stay here. We might be a slight increase in demand, because it's just very typical for September to pick up. But I think we're probably going to stay at this really, really low level for a while. I don't think it's going to get worse is kind of what I mean.
Yeah. I mean, obviously 20-year lows and you start adjusting for population and stuff
it's huge.
It's pretty ugly.
Yeah, exactly. It's already massive.
Yeah. No, fair. Okay. I tend to agree with you there. I think like, was the latest stat in June. I think it was 49% of new mortgage originations went variable. So that June would have been pre-BOC hike of 100 basis points. So I imagine that probably tapered off. Yeah. But you still have 30+% of the market that's been going variable, probably just to get around the more restrictive stress tests on the fixed rates. But it should be interesting. I think you might actually get fixed rates lower than your variable.
I wonder, you might. That's what I was wondering. It might be possible. Yeah, for sure. I think that
pretty rare.
Yeah, that'll be interesting.
So interesting and obviously very anxiety provoking times as we are entering a rate hike cycle. Many of us haven't seen such aggressive hiking as long as we were in charge of our pocketbooks and our budgets, but our parents did. And we had a viewer question last month that I'd like to tackle, a bit of a historical exercise. So a viewer asked us last month what pattern we've historically seen in Canada when interest rates were hiked and had a notable impact on real estate. And the viewer also wondered, when did the rate come back down, given what happened with prices and other things? So I thought it was an interesting question because this week I also came across, through the wonder of the web, a CBC flashback to 1981 Vancouver, when real estate prices were at their highest in the country, and a rate increase meant that there was a sudden difficulty in trying to sell homes. Let's watch that for a bit.
Homeowners have frayed nerves too, trying to keep up their mortgage payments, especially homeowners in Vancouver. Houses there cost more than in any other city in North America. Because of that, mortgages are among the highest too, and nowhere else in Canada are so many people so desperate to sell their property. Russ Patrick has a story.
Karen and Bill Hardy have been trying to sell their suburban home for 4 months. They've reduced the asking price twice to $239,000. They've been having open houses 7 days a week. Last month, a man from Calgary made a $100,000 down payment on the house, but he couldn't get a mortgage for the rest.
I don't think the price is the problem. I think it's the high interest rates. People just can't qualify for mortgages. I don't think it's the price at all.
So a lot going on there. So many questions, so much to absorb. Now, in 1981 Vancouver, the houses were selling for $250K, some bargains apparently at $180K, which just sounds nuts. And the bank rate was just under 18%. Now, of course, absolute numbers in the past always seem eye-watering, but I wonder if we could focus a bit more on the movement of the rate increases in these different periods. So 1980 to 1981, there was an average increase between the years. It resulted in 500 basis point increase, which then was a 40% change in the rate, followed by a cut the following year of 400 basis points, which then was a 22% decrease in the rate. So moving along to another time when we saw rates increase. John, you mentioned on our last chat, the 1990s, when and you described some of the factors happening in the Toronto real estate market when interest rates rose. Then we saw in 1990 an increase in the rate of 75 basis points, which was then represented a 6% change in the rate. And then a year later, 1991, we see a decrease of 400 basis points. And that then represented a 44% decrease in the rate. So look at some numbers there. Now, flash forward to 2022. We've seen the bank rate move from 0.25% in January of this year. It's now at 2.5%. Seemingly, we're going to go to 3.25. Some, John, like you mentioned, are expecting perhaps even higher in September. If it was 3.25 in September, that would represent 300 basis point increase since the start of this year. And that represents a 1,200% increase change in the rate itself. So before we even get to the next question of when do we think this rate will come down, maybe based on what we saw historically, John, let's just talk about the effect of these increases then versus now. Am I right in thinking the impact of the increase is bigger now?
Well, yeah, I mean, it's definitely bigger. I mean, the 1,200% increase is just because we basically started at zero. So obviously those increases have a bigger impact. But beyond that, I think the key thing, the key takeaway right now is that, when we're in a low interest rate environment, which is what we are, any change in rates, whether you're going down or you're going up, have a much bigger impact on the housing market and affordability, right? And so effectively, like a 3% or a 300 basis point change this year actually has a much bigger impact on carrying costs than a 5% increase 40 years ago. And that's just purely because of where we started to where we are right now. So, where you start is actually very important. And that's actually why we saw the massive boom in prices. When we think about prices are more sensitive to changes in interest rates when you're already low. Well, yeah, that happens when you actually go from whatever it is, 3%, which is what mortgages were probably pre-COVID, to like 1.5%. So that's we saw it on the way up and we're seeing it on the way down. And that's largely why we're seeing this kind of 20-year low in demand, because it has really affected people's carrying costs.
Steve, any thoughts on that, on the impact of the different increases historically and now?
Yeah, so if you look at Canadian household debt to GDP, I think in the 1980s there was about 50%. Now you're at 105%. So, households are much more levered and over indebted today than they were, back in the 80s, or 90s there. So for that matter. So I think it's a much different picture today. And so it's why everybody talks about like, the analogies today to like Paul Volcker and like rates are going back up to 10%. I don't think really factors in that like global debt to GDP is at 365%. So it's like, it's not really the same economy as it was, 30, 40 years ago. And you can apply that same thing to your parents back in the day could have bought a house for a couple $100,000. Like maybe they levered 3 to 1, right? I mean, today you're levering, 5 or 6 to 1 of your income. So the rate sensitivity today on these massive debt loads, I think is substantially higher than it was back in the. So people just are so focused on the rate and saying, well, your parents were paying 18% on their mortgage. Like there's no reason why it can't get there today. And it's like, no, we kind of have to adjust for the level of debt to really offset that. So I actually think like this is fairly equivalent to what we saw back then. Just an opinion anyways. Mm-hmm.
Yeah, so great point. So again, thinking of the different circumstances in each period are really important. So when we come back to the question of when might the rate come down, let's again look back in time to the 1990s. John, you mentioned last month that you took us through a bit of a flashback where a boom of new construction building across the suburbs in Toronto, maybe some of those McMansions, coincided with a temporary boom in immigration, which then receded. That resulted in huge home price drops and rate increases at a time when we were in a deep recession. There were worries that the free trade agreement that Canada had signed with the US was leading to permanent job loss, and Prime Minister Mulroney was looking to get reelected. So perhaps it's no surprise that the rate started to come back down in 1992 after we saw the high point in 1991. So looking to today and this question of when rates might come down, I was really interested in a post by our mortgage expert, Dave Larock, who blogs with us at movesmartly.com and at his own blog. And Dave was mentioning why he is revising his opinion on whether the rate will continue to go up. Previously, he thought the rate would come down a little, and now he's thinking it might take a bit longer. And the reasons are twofold. One, he was looking to see that those COVID-related impacts that we thought was leading to the recession. So we all remember the bottlenecks in supply coupled with this demand, as we all sat at home and I guess ordered too much Amazon, resulted in a huge run on prices. And there was, some thought that once that inflationary pressure, which was considered to be transitory, abated, we'd see the need for rate hikes to decrease. David is looking at the latest numbers, and what he's surprised by is that whilst a lot of the inflationary pressures that were due to that COVID period, so high shipping costs and other things, have come down, it now seems like, from the latest numbers, and I'm just putting on some on screen here, the consumer price index is showing widespread inflationary pressure. So now it seems like there was some kind of knock-on effect to areas that you wouldn't really expect. And slowly that's even now starting to impact wage inflation as well. So given this, David's kind of asking, what are we sort of in a new kind of inflationary story? What is it? And whatever it is, will the Bank of Canada and the US Fed have to be more aggressive in tackling it? And the second part of his thinking is that while the bond rate is pricing in rate cuts because they're anticipating a recession, he's wondering if they are overestimating that and underestimating how many rate hikes might come even if Canada and the US go into recession. So I'm paraphrasing David's comments here, but it's almost like one outcome could be that perhaps the authorities will need to allow us to hurt for some time. And the question is, for how long? So that's a lot of history. Steve, you mentioned last month that after the hike in September that's upcoming, the Bank of Canada would be done. Given the impact that we're already seeing on the real estate sector in Canada, which is very important to the Canadian economy, you felt like there was only so much hurt that could be absorbed. Is that still your feeling?
Yeah, I mean, I said that's what I'm going with. I mean, I think trying to predict rates in this environment is incredibly challenging. I think anybody that's stuck to one view or is, relying on one person's forecast, I think it's probably a mistake. I think that, a lot of this depends on, okay, how weak does economic data have to get? How much does inflation have to come down? How much pain in the labor market, in a economic contraction are these policymakers willing to tackle? Like, I don't think there's let's be honest, Tiff Macklem at the Bank of Canada or the US Fed, they don't even have a clue. They're basically just guessing. They're saying this is one giant experiment about how to basically try to rein in inflation without, crushing the economy. So that's sort of my view based on, I just think, the economic weakness. Again, they're not making decisions per se based on Canadian housing, but, let's be honest, Canadian housing essentially runs this entire economy. It's just the way it's been built, unfortunately. So that my view is that's certainly my view. Now, again, I think just because we say, hey, they might go 75 basis points here in September and then hold, it doesn't mean that they're going to be cutting next month. It doesn't mean they're going to be cutting by the end of the year. It doesn't mean that they'll be cutting in the first quarter of 2023. They might just hold at this level for, several quarters. Maybe they hold it here for a year. And if they do, it means your variable rates basically stuck at, 5.5%, John? More about what? Well, yeah, we about 5.5% roughly. So, that's extremely punitive for Canadian housing at these price levels. So that's sort of my view, is just because we say, hey, I think that they're one and done here at the next meeting, it doesn't mean that we've bottomed in the housing, bear market. I still think that we could actually have more pain into 2023.
John, your thoughts on that and historical versus now?
Yeah, I'm pretty sure in the 90s, I think we were in a recession at least the first couple of years, and rates were high, and I think they were high because inflation was still high, we were in a recession and they ended up dropping rates, but I'm pretty sure that kind of coincided with inflation kind of dropping back down. I can't remember to what levels, but they're probably, 6+% or something like that. And they dropped down quite a bit, I think, in the early 90s, 92, 93. So, I do think maybe that is some kind of historical precedent that they kept rates high, I think, in a recession, which is probably what made the recession even worse in the 90s, from what people remember. And then, once inflation got under control, I'm pretty sure is when kind of the rates dropped. So, and I think that's, again, when people trying to, and I agree with Steve, I mean, you can't really predict the future path of rates. Like, I mean, ultimately, I think it's a function of inflation more so than anything, because, it doesn't look like they're going to let up if inflation stays high, even if the market tanks, so I think that's one of the key things we're going to have to keep an eye on in the next, 3-4 quarters, kind of see if prices and inflation rates stays high, because that's going to tell us the future path of interest rates.
I think you have to factor in as well, like the political side of things. Like, as much as like, you'd like to like steer away from politics, like the reality is it's like, these are political entities, and like the politics around inflation right now are like, holy smokes, this is out of control. People are upset. We need to get this down. Like, that's, and at what point does it become, hey, what the hell are you guys doing? Why are you still raising rates? I just lost my job, or, my business is going under, or what have you, or I'm foreclosing on my mortgage. Like, at some point, I think the political discussion will change from, hey, inflation is really bad, we need to do something about it, to, hey, there's a lot of problems in the economy, and we got to talk about interest rates, or what have you, right? So I just don't think like the political air cover right now is there for any of these policymakers to suddenly pivot and cut rates next 2 months from now. I think like the discussion right now is solely around inflation, but I do think it's going to pivot around economic weakness at some point.
Political, you don't think the bank's completely independent?
Oh, buddy, don't get me started.
Well, I'm not sure if Tiff Macklem collects watches, but according to one measure I saw floating around on Twitter, is that maybe the prices of Rolex's resales coming down for the first time in many years might cause alarm. But
used car prices are coming down.
Yeah.
Oil prices are coming down. I don't know. But we'll see. I think John, I don't know about John per se, but, I was certainly in the inflation camp for the last, 12 to 18 months. But I think like everybody now is just totally on one side of the boat. Mm-hmm. So it makes me kind of think that, I don't know, I think this economic softness should bring inflation down faster than maybe we expect. But
yeah,
hard to predict. I don't know.
Who knows exactly.
Yeah, buckle
certainly
in.
Don't go out there making $2 million purchases off one video that you watch of John and I trying to predict inflation. So please, full disclaimer.
I think you guys have been cautious.
Right.
On that note, let's talk about the impacts on the real estate market. You mentioned, Steve, a bit of a tug of war feeling between buyers and sellers. John, a member of your sales team, Gus P, shared a really cute GIF. Basically, talking about this, there's not enough listings, so sellers don't feel like they need to decrease prices if they don't need to, and there's not enough buyers to keep others from coming into the market. So what will happen first? Will buyers jump back in, or will listings surge this fall? John, I'm not sure you would characterize it as a tug of war, but this also coincides with the question we got from our YouTube viewer, Bobby Claire. John, you said you expect buyers to return and activity to increase in September. Do you expect the same on the sell side?
Yeah, we're definitely going to see an increase in new listings. I mean, again, this is my gut instinct, and take it with a grain of salt because it's still early, but I think buyer demand is probably going to outpace listing demand, at least over the next few months or a couple of months. And I think that's probably going to lead to a slightly more balanced market. We're still going to be very low sales volumes. I think homes are going to sell a little bit faster. I think you might see a couple homes with, a couple bidding wars, but not like it was in February. So I think things will be moving a little bit more quickly because there's just not a ton of inventory. So the stuff that does come out, if you have more buyers looking, they're going to be rushing to go to those nice new listings, right? A lot of the listings that are in the market now in August have been on the market for like 3 months or 2 months. So I do think it's going to be a little bit busier. Again, I think a lot of people might kind of extrapolate and say, okay, this is the bottom, we're past this, price are going to hit the moon after. Obviously, that's not the case. We don't know what the new year is going to be like, but I think the fall we might see a little bit of plateau, at least, or if not a plateau, even a price dip. It's not going to be like it was in the spring, I don't think.
Steve, I know you touched upon it, but any thoughts, additional thoughts there?
Yeah, I think just like looking at the pipeline ahead, I think you're going to see more transactions in the fall, right? Like I think we're definitely going to get more listings. For sure we are, and that's partly seasonal. But I think you definitely gonna have more buyer demand as well, partly seasonal. So I think it's going to be an uptick in transactions and activity. Like I said, I think we're moving away slightly from this completely illiquid market where like you almost basically couldn't sell anything to, yes, it's still a weak market, but people are transacting today at lower prices, which are offsetting slightly higher mortgage rates. It's still at a point where the level of affordability has deteriorated because prices haven't necessarily come down enough to offset that. But I mean, I'd like to put something in context. Like I just did a deal out in the suburbs more recently, and I don't really go too far out in the suburbs occasionally, but we picked up an investor client of mine. We picked up a condo that was 30% to a T, 30% below the peak pricing, because they're comps. It's a condo, right? They're very easy to price. And so we picked up a condo that was 30% below what the comps were selling for in February. So, okay, it's down 30. Can it go down another 10, 40%? Probably, maybe. But it's like, that's a 30 to 40% drawdown. Like, how much more are we looking for? I know everybody's looking for things to realign with local incomes, but I just think like we've had a huge move already in large parts of the market. So I think while I believe that if rates stay at these levels, I think that we continue to sort of leak lower. But I think like the big sharp move down, I think we've had that big sharp move down. I think it's going to be a little bit more subtle or a little bit more calm in terms of the sentiment. If that helps explain things.
It does. I think there's some interesting stuff, John, you were talking about around, how likely is it that people would start to sell off? Many people have secondary investments. Steve, like you mentioned, your client had. So there's a question around, I guess how much equity people have and what their positions are. And that's something I think we should look at in future chats, maybe see if we can get some idea of the numbers around that, around the exposure of sellers. This week, we don't have a lot of time because we have to get Steve off to his honeymoon. So we're going to, I'm going to end with one final thought. The state of your industry, John and Steve. Looking back at that CBC clip, I enjoyed the commentary of the then real estate board head. He didn't quite say nothing to see here, folks, but sounded a bit like that. And Steve, while you're worried that our viewers might be led astray, I feel you and John are quite measured, unbiased, of course, but you are measured in your commentary. On the other hand, on YouTube the other day, I saw a show from some in the industry in the Toronto area talking about the market slowdown being, false news. It's not quite how they said it, that prices were still up year over year and that this would all kind of go away. So I'm wondering, John, is there some measure of denial going on in the industry?
Yeah, I've been seeing that a little bit as well, which is kind of interesting. I mean, if you have realtors right now talking about prices are still up year over year, I mean, quite frankly, they're completely misleading you because, prices, like as Steve said, 30% down from the peak in February, very similar declines here. So it's a good news story to talk about prices are up year over year. But that's obviously it's highly misleading. And I tweeted like last week, I mean, the reality is even if we see a plateau or a balancing out in the fall market, we are still very early on in this high rate cycle and environment. All we've seen is demand plummet. We haven't seen much distress from sellers yet. And I think until we get some insight into if that happens and to what extent, we're not really going to know what prices are going to look like in the new year. And I think it's going to largely be a function of how sellers or investors are impacted in this market, especially with rates this high. So it's still very early to be celebrating, which is a lot of agents are doing right now.
Steve,
yeah, I think. Yeah, I think that it's funny. Like John, I'm sure you probably get the same thing, but like I'm considered like the perma bear in my industry of like, oh, that guy's always so negative, pessimistic. And then when I go on Twitter, I'm called like the market pumper. That yeah, I'm a shill, right, for the housing market. So it's like, which one is it? Like it seems like you can't really win. But I would say like my opinion is like, yeah, I think it's much too early to like suggest like we have like a trend in place for August slightly picking up, and just because rates might hold on pause, that like it's all clear. Like I think we have to put in context that we had the last 10 years in the housing market here have been like insane, like more than a doubling in prices, et cetera, et cetera. Like, I don't think we can rule out all sorts of various scenarios, which is like another scenario that people somehow forget is like, in the 90s, we had 10 years of like flat and no growth in these markets. So like, could we potentially go from like, okay, we had a huge run in COVID. Now we came down, depending on the market, we came down 10 to 30%. And like, do we basically just like move flat now? Do we move sideways for the next 2, 3, 4, 5, 6 years from here? Like maybe. And I think that's a scenario that, would still be, I think, painful for a lot of people, right? Like if you bought at the wrong time, you will be stuck in your home for 6 or 7 or 8 years. So, and it's not really a market that I think people are potentially prepared for. I'm not saying that's my base case, but I think we have to be prepared for all sorts of options in this like crazy world that we're in right now with everything that's happening, politically, geopolitically, and through monetary policy. So
I think the adage is, Steve, if you are upsetting everyone, you're doing something right. So
hopefully.
So good note to end on. I thank everyone for watching us. John, Steve, thanks as always for your comments. Viewers can send us your comments at our Move Smartly channel on YouTube, on Twitter at John Pasalis or at Steve Saretsky. I'm at Move Smartly. And you can also email us at editor@movesmartly.com if you have any questions or feedback. Thanks again for watching, and we'll catch up with you next month. Hopefully Steve will be nice and tanned and relaxed.